Hello everyone, thank you so much for joining me today. For today's video, I want to review some of the data sets I'm looking at for the auto market as well as the Fed and the housing market. So without further ado, let's go ahead and get started. Real quick, Susan Y, John P, Sleepy Squid, Sujit R, and Don, thank you so much for joining the channel by clicking on join right below this video. Really appreciate your support. You guys are awesome. Thank you so much. So we'll start with this item. This is from Sawyer Merritt on Twitter. This broke last night around 9 p.m. Central. Breaking, Tesla has officially reintroduced the Model 3 long range in the US after an 8-month hiatus. It starts at $47,240 and has 325 plus miles of range. This car is running between the Model 3 rear-wheel drive base version and the high-level Model 3 performance that Tesla offers on its website here in the United States, starting at $47,240. Now, this specific model was removed from the Tesla website in August 12, 2022, last year, so almost a year ago, and now it's been reintroduced for the U.S. market, slotted right in between, again, the lowest model and the highest model for the Model 3. Now, this specific car is eligible for the federal EV tax credit. However, it qualifies for $3,750 instead of the full $7,500 amount. And there's been a lot of speculation why this is. One of the requirements for the federal tax credit is that it has to be manufactured in the U.S. or partner countries, as well as its battery manufacturing and raw materials. So one of the things that folks are thinking about is that this battery could potentially be from China with its LFP, sort of this lithium iron phosphate chemistry that would not make it fully eligible for the $7,500 credit. Instead, it would get the $3,750, just like the rear-wheel drive base model version for the Model 3. If we put all of the models together on a list for the Model Y Model 3, and we sort them by the lowest net price first down to the highest, you can see that the Model 3 long range is sort of slotted in the middle. The cheapest version after the EV tax credit is the Model 3 base version, which is a rear-wheel drive with 272 miles of range with a 0 to 60 time of 5.8. The net price is $36,490. And then the Model 3 long range is $43,490, while the Model 3 performance is $45,740. However, what's very interesting here is that the Model Y long range, which is an SUV, has slightly higher range. We'll wait to see what this plus actually means once Tesla releases the sort of the formal range. Slightly longer range, an SUV form factor, which means it has more room, is actually about $750 cheaper. So the Model Y long range is cheaper by about $750 versus this brand new introduced Model 3 long range. Now, from my standpoint, I think what Tesla's strategy here potentially is that they're trying to incentivize more sales towards the most profitable model potentially. But I'm also hearing that folks, aren't necessarily looking to buy an SUV. They want to buy a sedan because they just like that form factor better. And this could be an introduction for those folks. And so the premium is due to maybe a more sporty form factor. It's a little bit quicker than the Model Y, and it doesn't have more range, but we'll see what the plus means. So we'll have to hear your thoughts about this change. Would you buy the Model 3 long range or the Model Y long range? And what would be your decision to buy one or the other? I'm actually very curious to know why Tesla did this. If you're enjoying this content so far, I would love it if you throw me a like. It helps the YouTube algorithm show this to more people. Thank you very much. Really appreciate your support. Now, as it pertains to the Federal Reserve, here's a tweet from Rob Maurer at Tesla Podcast. If you don't follow Rob Maurer and you like to follow Tesla-specific news, please do so. He's one of the best out there. The Fed has just raised rates by 25 basis points and has removed language in the statement that the committee anticipates that some additional policy firming may be appropriate. In determining the extent to which additional policy firming may be appropriate to return inflation to 2% over time, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. This is what the new languages that replace the anticipation that some additional tightening will be appropriate, also known as increasing rates. This basically means that it's unlikely for the Fed to continue raising rates from where we are now, depending on some economic activity. But this is obviously something that folks that invest in the stock market and people that are following sort of the home markets and the car markets very closely, this is going to give them a little bit of joy, because this means that the rates won't keep going higher for those interest rates that people will be looking to take out for those loans. Now, if you look at this report from Renaissance Macro Research, this was posted by Business Insider. America's housing market is bouncing back. This is tracking the blue line here, which is the housing starts single unit, which is basically a single family home. And then the yellow line, which is a new one family house sold and not started. So we can see that ever since really the start of the year, there's been sort of a flattening of new housing starts for single family homes. Quite a big decline since the pandemic. We all know that the pandemic had a huge surge due to basically zero interest rates. And then the new one family houses sold is starting to bounce back, but it's not really at the levels that we were at before the pandemic. For housing starts actually out there and being built, we are back to pre-pandemic levels, but we'll see if this is actually a bounce back. I think this is more a regression to the mean, and the not started sort of units have to get back to those levels for us to actually say that they've bounced back. So curious to see where this goes. Hopefully the rate hike pause moving forward will be good for this market. Now, the other part of the economy that's going to be heavily reliant on interest rates is going to be the auto sector, and Stellantis reported their earnings today on May 3rd. Stellantis also has brands like Chrysler, Dodge, and Jeep, but I do want to make sure to highlight that the reports of profits for Stellantis is every half year, and so Q1 will not have profits listed, only revenues and units, and so that will be missing from this report, but there's still some pretty interesting trends that are happening with Stellantis that I want to highlight. In case you're not familiar, Stellantis has a bunch of brands. They're basically a conglomerate, very similar to Volkswagen and GM. They have brands like Alfa Romeo, Citroën, Fiat, Lancia, Maserati, Opel, a lot of these sort of European-specific brands, Peugeot, but they have Ram, Jeep, and Chrysler, and these are their brands in the United States. Most of these, if not all of these cars, are really SUVs and trucks, and that's what Ram, Jeep, Chrysler really specialize in. Some sedans for Chrysler, but yeah, that's basically the brands that they have. Real quick, before we move forward with their earnings, I want to let you know that a new article has been dropped on my Substack, farzadmisbahi.substack.com. You can follow that link if you like in the description below if you want to support the channel. Thank you so much. So for Q1 in 2023, Stellantis revenues were $52 billion, about 47 billion euro. Since they're a European company, they report in euros. It's up 7% versus the first quarter of 2022. However, there are some trends that I want to highlight specifically with Stellantis that impact the US market. So market share declines in North America is down about 160 bips, which is 1.6%. And the EU 30, which is basically the 30 major countries in Europe, down 170 bips or 1.7%. South America and the Middle East deliver gains of 20 bips, 0.2%, or 2.3 bips, 230 bips, which is 2.3%, and that's in Africa. Now, I want to hone in on the North American market. I think there's some interesting trends happening here. This is commercial metrics that's gathered by Stellantis that describe the auto market that Stellantis is playing in. So it's not necessarily their sales to the market, but it's what they think their market is doing that they're selling into in the United States. They're quoting a decrease from Q1 2022 of last year to Q1 of 2023 from 462 to 432. This primarily highlights what I'm guessing is the pickup truck and the expensive SUV market that's been coming down dramatically ever since the Fed increased rates and it made it more expensive to afford a more expensive vehicle. So you can see a decline here, even though their total metrics say that, hey, we're actually growing as an overall company. And in North America, we're actually going down. If you contrast this to how much they shipped in the actual North American market, if we look at the shipments here, they went from shipping 480,000 units in Q1 of 2022 in North America, which is going to be primarily Jeep, Chrysler, and Dodge, up to 509,000 units in the first quarter of 2023. So sort of a modest, call it a 5% increase from Q1 to 22 to Q1 23. However, this trend here around inventory is something I really want to focus on, because even though they're shipping more and their metrics are saying that hey, people are actually buying less, their inventories are still going up, which is, I think, going to be a cause for concern for Stellantis, and you'll quickly see why. So this is their inventory levels from quarter to quarter, starting June 30th quarter in 22. So this is basically Q2 of 22. You can see their inventory levels for independent dealers, basically the companies that hold inventory for Stellantis. If you go to any dealership, Ram dealership, that's basically what they're talking about. And then you have their company inventories, which is how much they have on the company lots at the manufacturing plants with Jeep, Chrysler, Dodge, and maybe on boats or in containers getting to the dealers. You can see that their inventory for independent dealers has been going up since the second quarter of 22. However, if you compare their current inventory, so as of the end of the first quarter of 23 of 918,000 units, if you compare it to March 31st, 2020, which is the quarter right at the start or right before the pandemic began, you can see that their inventories are significantly lower than they were at the beginning of the pandemic or right before the pandemic started, which says that, hey, we're building inventory to try and get to those levels. And so that's some of the verbiage you read here. If you want to read the slide, you can. I'll leave it up here in case you want to read through it. You can pause the screen, but that's sort of what they're saying. However, what's important to highlight here is that the current dealer inventory is at 65% of pre-pandemic levels, but there's nowhere to put these cars, especially in the United States. So even though they're claiming that they want to build inventory up to try and get to pre-pandemic levels because of, chip shortages and so on and so forth, the United States is very full. How do I know this? If you go to Cox Automotive, which is one of the the premier places to really get automotive data, they have this days of supply chart that really highlights how much days of supply each brand has on hand. And this is as of the end of March. You can see that the national average here is somewhere around 55 days, which is right around the 60-day on hand that legacy automakers want to have on dealership lots. But if you look at the three brands that are highlighted in red, Ram, Jeep, and Dodge, these are the three brands that Stellantis owns. And these three are significantly above healthy levels. Dodge is somewhere around 90 or above 90. Jeep is somewhere above 110 days. And Ram is much closer to 120 days, almost double the healthy amount. So again, Stellantis is at 65% of what they usually have on dealership lots. Now, this is globally, but I really want to highlight this in the United States. But in the United States, they're super, super full. So they're not even close to where they want to be, but they have nowhere else to go, at least from a dealership perspective in the United States. So it does seem like Stellantis is in a very strange position. Chrysler, Jeep, Ram has significantly above healthy levels at U.S. dealers. And Stellantis is going to have to figure out how to clear the lots in the United States. And this is probably going to have to be done through pricing. They're going to have to make the prices for their cars in the U.S. much cheaper, or they're going to have to figure out how to offload it onto customers, maybe sell it to fleet owners. I don't know. This is sort of a weird spot for Stellantis, in my opinion. We'll see what happens. And if they do decide to lower the pricing, how is this going to impact Stellantis' profitability when they're trying to go down this path? Are they going to be able to do this without losing too much money by lowering costs on their side? Or is this going to be done at a loss where dealerships are going to have to basically eat the costs and Stellantis is going to have to help them out with incentives or something of that sort? And then you think about the current Fed rates. Now they're at 5.25, I believe, or 5. How do current Fed rates impact this? So now we know that the Fed has increased it another 25 bips. They've stopped, but it doesn't seem like they're really going to lower it anytime soon. They're probably going to wait another 3 to 6 months. are these dealerships going to be able to clear their lots between now and then? You know, is it going to be late year while Stellantis is still trying to sell them cars, and these dealers are going to be like, hey, I don't know what to do. I have a full lot. I can't get people to buy because they're too expensive. I need some help here. So we'll see what happens. It's really a very strange situation for Stellantis, and I'm really curious to see how this pans out. Another thing that Stellantis has to think through as well is, as the US continues to accelerate its electric vehicle adoption, is Stellantis ready to really embark on that journey? What about electrification? There's a slide on Stellantis's earnings deck that says all electric 2025 Ram 1500 REV unveiled. This was basically the Ram pickup truck, sets new industry benchmarks with its powerful combination of range, towing, payload, and charge time. However, this truck is not going to come until late 2024, so about 18 months from now. And then they have also a battery electric vehicle offensive in North America approaching. So they have a ProMaster set to launch later this year, while the Jeep Recon, Wagoneer, and Ram 1500, again, they'll arrive next year in 2024. And they're planning on offering 8 different battery electric vehicles in North America by the end of 2024. Now, I had no idea what the ProMaster was, and so in case you're interested, the ProMaster is basically Ram's van line, and this is something that they're looking to electrify here by the end of this year, but I'm curious to see what kind of stats they have for those vans. So if the market starts shifting to electric vehicles in the US, we're seeing a lot of that happening now. We know that the Tesla Model Y thus far in 2023 is the best-selling non-pickup truck, period, outselling the RAV4. So there's clear movement towards electrification. Is Stellantis ready to shift over? Their electric vehicle sort of ramp doesn't really start until late next year. And so that's about almost 2 years where Stellantis might be behind schedule, especially as it pertains to Ram, Jeep, and Chrysler. So curious to see how that ends up. But what I really want to know is what you think. What do you think about Stellantis' latest moves? Do you think they're well positioned to go into electrification or to sort of survive this high inventory level in the United States for Dodge, Chrysler, and Jeep? Let me know what you think of the Fed latest moves. And if you want to see more videos from me, feel free to subscribe by clicking on subscribe right below this video. And lastly, if you want to support the channel, I have some merch in the description below. You can click on my website in the description and you can get one of these shirts or some other shirts and hoodies and stuff that I have on there as well. Thank you so much for watching this video. I hope this video was informative and helpful, and we'll see you on the next one. Take it easy, everybody. Bye-bye.